Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, May 23rd, 2023. Welcome back to the podcast, George.
Thanks for having me back on.
Yeah, good to have you. And as always, there's plenty to discuss in the macro world. Why don't we first explore the most pressing matter, which is, of course, the debt ceiling. As you know, we're a little over a week away from what is referred to as the X date, which is sort of being approximated as June 1st. As many of our listeners know, that's the date where the U.S. Treasury runs out of cash in the Treasury General Account, or TGA for short. Negotiations are ongoing and certainly have heated up, with Biden returning abruptly, cutting his trip to Asia short and returning, I believe it was on Sunday. Plenty of headlines today and in the next couple of days. Situation is obviously very fluid. But George, why don't you give us your latest take on where we stand with regards to the negotiations, as well as some likely scenarios that could play out in the coming days, and the potential market implications for those various scenarios.
Yeah, no, it's definitely a fluid situation. So I'm glad you pointed that out. We need to acknowledge that, obviously this podcast is being recorded in a time where negotiations are live and things can change in a heartbeat. But I think given that we're in that 1 week or so plus window, one would expect that at this point there's some gelling of what sort of deals starting to take form. This debt ceiling discussion has felt differently, at least in my opinion, from what I've experienced, really since the start of my career. They've gotten more contentious, especially after the financial crisis, the 2011 being the most noteworthy one. And so, in comparison to what typically has happened in these debt ceiling negotiations, there's been there'll be a lot of just brinksmanship, and sometimes there's acrimony, and it feels like things are not getting done. Whereas this time, it's almost as if they've taken a new tact of really saying that they're working towards it. People are feeling optimistic, but yet they're not really giving us any specifics. And so it's really the market's taking it at face value that we have to trust that there's progress being made. So one must assume that a deal is in the works. However, the clock is ticking, and at the same time, I think we're starting to come around to the idea that, although default would be, a really, difficult thing for markets and for the U.S. economy and global economy, most likely they can avoid default too. So I think people are starting to get their arms around the idea that perhaps the default is not really on the table anyhow, and that's why the markets are sanguine. That said, we have seen markets start to get a little bit nervous as the clock keeps ticking. This is Tuesday, and we have a long weekend ahead of us. And so, my view, very simply, is that if we don't get more details or evidence that there is a deal being formed before Wednesday night, early Thursday morning, there's not much trading days left in the week for markets to kind of get more defensive and take more of a risk posture that something doesn't go as well into the early part of next week. Speaking of what could be the worst case scenario, would be some sort of prioritization of payments. I don't think we have to get there. It's either a longer term solutions being worked on, or what's still in the background, a short term suspension that could get us into September. Suspensions won't count towards the debt limit. They can then continue to issue debt and then re-up the overall debt limit once there's a better deal in place. And so I think that there's options to avoid the worst case scenario. Number one, there's hope towards a bigger deal, but the fact that there was 2 months without real negotiations, and we're talking about some really complex matters where both sides are pretty much on opposite ends when it comes to spending as well as raising tax revenue. I'm hopeful that they get something done, but I'm also hedging myself to the view that perhaps it's a short-term deal versus a long-term deal. Either way, once we get through this in the coming week or so, the U.S. Treasury is going to have to issue debt and pay back some of these extraordinary measures that they tapped into. And that plus just funding the deficits on an ongoing basis, will require a lot of treasuries. And so I think what people are failing to realize and are, I think, underappreciating, although it's an potential imminent danger as we get closer to the limit and the window of the X date next week. And perhaps the bigger issue is what happens afterwards with this draining of liquidity, right into a period where rates are really high for the U.S. We haven't been here for many, many years, and then what that might do for overall financial conditions. So I'm taking like one step further, assuming that this gets done in some form or another, and then focusing on more of the implications of what gets done afterwards.
Yeah, I love how you ended on that point, and this is something we've talked a lot about, offline. But and you've mentioned, so you have huge amount of bill issuance potentially once this gets resolved. That drains a ton of liquidity. You also have, banks presumably pulling back. You have rates higher, as you mentioned. We've talked about how how there's also liquidity being drained in Europe with the TLRTOs, pandemic-related TLRTOs getting paid off. I think that's in July, if I'm not mistaken. Being a Japanese bank, we always are mindful of the BOJ abandoning yield curve control, which is obviously de facto tightening there. That's a lot of tightening going on at the same time. So yeah, really really good point there. So switching topics somewhat, but obviously all interrelated. The Fed is always top of mind, but has taken a back seat to the debt ceiling here. Assuming the scenario laid out, plays out. You're right. We avoid a default. There's a resolution, whether short term, long term, but we get it, in time. The focus will inevitably turn to the Fed, and in particular, the minutes from the May FOMC meeting, which were released on Wednesday, May 24th, which is likely the same day as most of our listeners are listening to this podcast, as well as the upcoming June FOMC meeting, which is being held on the 13th and 14th. Ahead of these events, some recent Fed speak has been, particularly hawkish. I guess I'd be curious your take on that latest Fed speak, as well as sort of what you're expecting from these two events. Given this, hawkish rhetoric, given what the minutes are likely to look like, does the Fed pause in June?
Yeah, no, there's a lot going on the Fed front as well, and I think we'll turn to that once the debt ceiling is resolved for sure. Recent Fed speakers, even centrists like Logan, have sounded and felt a little bit more hawkish, and but at the same time, there's been a number of other Fed speakers that are open to the idea that this credit channel tightening could be equivalent to a number of hikes, and so I do think that heading into this next meeting, it's going to really come down to um, how the debt ceiling gets resolved. Is there any sort of kind of spillover into broader market financial conditions to the downside, that is, or is there kind of a relief that it's over, coupled with we still have an NFP as well as CPI before the next meeting. But by and large, our view, which hopefully our readers and listeners know, is that the Fed most likely is done tightening, and that the May meeting was the last one. That they're going to take into account this credit tightening as well as the long and variable lags of all the policy tightening that was done already. But you have to understand why the Fed, as well as just Fed speakers collectively, have perhaps turned more hawkish in their speaking. I think they need to talk tough in order to ensure that the policy that's been put in place remains effective. In many ways, I've used the analogy: a body in motion stays in motion. But when you pause, you really have you have to kind of defend your position of why are you at these high rates, and why aren't you either hiking more, or why aren't you cutting like the markets are expecting? And so you're going to just sitting there doing nothing and defending your position. You're going to have to then use speeches and forward guidance in a way to kind of convey that this is the reason why you're at these levels of rates. And that's harder to do when you're not in motion. You're kind of just sitting there defending your position. So I think that's probably why we're getting this uptick in Fed hawkishness. I don't think it's necessarily indication that they're going to have to continue their hiking. And we also have the June meeting ahead. I'll give a really brief mini preview because we'll spend more time on it. Last week on Friday, Chair Powell, on the other hand, sounded a little bit more dovish versus all the other Fed speakers. We've also now have the R star, which is almost like the North Star for long-term rates, which is the neutral level of rates where the Fed thinks that rates are not expanding or contracting the economy. Perhaps that long-run dot, the R star, because it's back up and running at the New York Fed, perhaps it's higher. We have more inflation frictions in the market, and things perhaps have changed post-pandemic that the real cost of capital, the real rate is actually higher, and therefore it requires a longer term higher dot on the long run side. So, if the Fed were to skip, which we think they will in June, it could be a hawkish skip because they could change the path on their expectations for rates down the road, as well as where the steady state will be down, in the future. So I think if that were to happen, it's slightly bearish long-term rates, a little bit of a curve steepener. But at this point, our concerns are really two things. One, the path of rates from here, and what happens with the balance sheet. I'll take the rate path first. The Fed really has four scenarios, but in my mind, it's really three. But of the four scenarios, of course, they can hike more if they so deem they need to. Market so far has probabilities well under 50%, so I don't think that's the case unless things change materially in the next 2 weeks. They could pause for longer, which is not what I'm expecting, but that could be what they end up doing, and they defend their position at 5% higher in rates. Or, which is my view, which our readers and listeners should know, but really kind of try to help clarify what the view really is. There's two kind of paths towards cuts. One, a short pause, and then there's fast cuts. And if that were to happen, that really requires another sort of financial accident or some other impact from all these Fed tightenings, either results in more regional banks coming under pressure or some other part of the financial system that just really cannot handle the higher rates, like non-banks or private credit, private equity. So that could be what could be a catalyst for a short pause and then a much faster cutting cycle. But even then, I wouldn't expect them to go back to zero rate policy unless it's a really bad recession. Or four, a gradual easing if we get inflation back closer towards their target, at which point they would just gingerly cut rates at 25 bips every other meeting or something like that. 3 and 4 is kind of where I'm at, and so if I blend the two views together, it's what justifies the forecast that I have. Just for those that are interested in how I came up with my logic. And then the other thing that the Fed's also doing still is they're shrinking their balance sheet. And one thing which some people call the Bernanke doctrine, which is you cannot have your two levers of policy going in different directions. In other words, the Fed right now has their balance sheet shrinking, which is a form of quantitative tightening, QT. But if they were to start cutting rates but maintain QT in place and also potentially also tweak the RRP, that would be going against this kind of long-held concept that the Fed should not be going in opposite directions with their policy tools. We've heard from people on the Fed, Waller, and a couple months back saying that nothing stops them from cutting rates, but also continuing to shrink the balance sheet. But they've never done that before. So I think those are the things that I have my eyes on to see if future policy changes. I doubt we're going to get it in June, but I think it's going to be a topic of discussion over the course of the summer and probably into Jackson Hole, something to look forward to down the road. And I think that all is going to justify the Fed easing. But it is a out of consensus sort of view, relatively speaking, even though the market has these priced in, some of the kind of eases have come out. And I'm not changing my view. I think that eventually there's further things are going to break in the financial system because of these rate levels and QT that eventually it's going to force the Fed's hand.
Yeah, absolutely. We've already seen, you've been saying for a very long time that rates go up and something breaks. We've obviously seen that happen with, with the regional banks. It certainly is not unreasonable to expect that something else could break, at or around these rate levels as well, especially with QT going on in the background and all that liquidity draining that we discussed, in the previous question and answer. So we've gone over the debt ceiling gone over the Fed, a lot to contend with in the coming days and weeks. So get some rest over Memorial Day weekend. George, what else are you focused on as markets get ready for what is typically a slow summer? Although I'd sort of bet against that this year.
Yeah, so again, recapping, this rate shock turning into credit crunch is probably in its early innings, and let's see how far it goes. We're again, these long and variable lags of all this Fed tightening is only really showing up now in our view. The global liquidity draining, which we discussed, plus let's see what kind of debt ceiling resolution we get. If it comes with less fiscal spending at a time where the economy is decelerating, that's a risk that, although it won't be like an imminent risk, it still will take out potential growth and slow things down. Of course, I'm not going to go into commercial real estate, private credit. That's a whole other topic that we can look into down the road, but that's still out there. And a new worry that I have is, people have been basically calling out, the dollar's demise or de-dollarization, and that the dollar's days are numbered. And whenever that happens, I've always found that the dollar manages somehow to always come screaming back and exerting its influence as still the main currency of choice, and at times also, is in high demand when we get into these liquidity withdrawal periods. And so I'm concerned about just overall, gaps in liquidity overseas around the dollar, which might then, cause a pretty big rally, as there's overall kind of short bias, either mentally or in positions around dollar views, that would really trigger the risk off and really get this financial conditions tightening problem. It would in short compound all the things we discussed.
Okay. All right. Well, we will, obviously don't have a crystal ball there, but those are a couple things to watch out for, and obvious potential future topics for upcoming podcasts. Great stuff as always, George. Thanks for coming on the podcast.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.